Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark on crude prices. David Gerwitz from CharlesNenner.com wades in on the direction of the equity markets. Darrin Hopkins from Richardson GMP urges the government to eliminate capital gains taxes to boost the economy. We'll talk to Ross Clark right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600. Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
We're speaking with Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. Welcome to This Week in Money.
It's always fun to be back.
Ross, we have some good news to start the show with.
Yeah, those U.S. employment numbers, we wait for them every month, and as of this week, we've got a number that is good, showing that the 321,000 gain in non-farm numbers in the States, which is a good number. And on top of that, you're starting to see some wage growth as well. So that puts a little bit of the fear of potential inflation, but, pretty small numbers, maybe annualized at a 2% level, nothing to write home about. But this pickup in the employment stats there is enough to make people question as to how long rates will stay down. And interest rates, now the talk is that they could move as early as next spring. On the other side of the coin, in Canada, employment numbers not good, and with what we see happening in the resource side, I wouldn't be surprised that they even get worse in the coming months here. Now with those numbers coming out of the States, the little uptick in rates, we're down maybe a half a point in the bond market today. Good movement in the U.S. dollar index, up about 0.75% on the day. All the currencies, including the Canadian dollar, down, 42 points on the dollar, looking at it here right now, about 0.5%. That puts it at new lows for the year. Still thinking in terms of 85 to 84 as a reasonable target for the Canadian dollar. Not an excessive number, but I think that's the type of level we can be working towards.
And that's the kind of number, too, that helps attract things like the film industry.
Oh, sure. But you also have to make sure that you have taxation being comfortable for them here as well when they're going to do business, and that's been another issue. One of the things I've been looking at here, and we talked about it last week, this break in the crude oil price, as of last week we were down into the 60s, sort of $67 to $69 range. We finish off this week around $65. And I've had some people say to me, well, isn't that a state of showing how weak maybe the economy might be? And we've got copper prices under $3. And I did some work, and I think this is of note. When we look at these periods when the oil market has been broken down from a consolidation area, and in this case, this would be the consolidation between that $80 and $100 range from 2009, 2010, right up until September. And there's half a dozen of these long consolidations when we look back over 40 or 50 years. And every single one of them, the equity market did well during the break in the oil price. And when I say the equity market, I mean the industrial market. Forget about the resource stocks. If we take a look at an S&P or a Dow, or the TSX excluding energy, you find that market, as I say, does very well during that period of declining oil prices. And once oil bottoms out, then there's another up to 6 weeks of good action as far as the equities are concerned. So here we are with oil still trying to find a bottom. Maybe it's here, maybe it's 50, maybe it's, pick a number. But once it starts to stabilize, then I think we can still look at a really nice window in terms of upside action for the stock market. And the oil market itself tends to take somewhere between 2.5 to 3 months once it's had its initial low before that stability is enough to produce a good sustained move to the upside. Great example would be the last time we saw this in 2008. Oil got down to $35 in late December, rallied back to 50, then back down to 35, back up to 48, back down to 33, and all of that within like a 6 to 8 week time window. So it's the thrashing around, the ability to build a base that I think we want to watch for once it looks as though this market has found a bottom. Don't be in a rush to, make a long-term investment in terms of a buy and hold. Let the market stabilize, prove itself, and then look at investing some dollars. And if anybody's interested, I do have a chart showing that correlation of oil versus the S&P. They can send me a personal email at ross.clark@cibc.ca.
Ross, thanks a lot for chatting with us.
Thank you.
Ross Clark has been our guest, investment advisor at CIBC Wood Gundy in Vancouver. Coming up, David Gerwitz from CharlesNenner.com on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at TalkDigitalNetwork.com.
My guest is David Gerwitz, Managing Director of the Charles Nenner Research Center. Welcome back to This Week in Money.
Hi, thanks for having me. I really appreciate it.
Well, we have a number of markets to take a look at. First, gold had a huge upside reversal day on Monday. Now, is that going to be a sign of a bull market?
Well, we don't look at that. We look at cycles, not just like one day outside reversal day. That's what's a term of art. But we think, like we wrote today, gold, we're disappointed gold and silver can't get going because cycles are up. And we have no position in silver. We want to keep that away for now. We're long gold, but we continue to watch closely, keep a self-stop around 1190. Like we're near a bottom in gold. We got out 3 years ago in 1900. So getting near, but it still takes a few weeks. But longer term, we're going back to the highs. So those who have it should hold. Those who are in may want to put a hedge over around 1190, but we don't think it's going to be down much more. If it is, it's just for a short time, but we really think we're going to start to take off. This bottoming process started in July, and there have been 4 bounces in the last 6 months. But they didn't get going yet, but we think it's going to get going.
So silver still a hold for you?
Silver we're not holding right now, but we think it's going to go back to its highs. We're just not there yet. We're not ready to start buying. 16-something was a buy signal. It didn't get there. So our system's pretty rigorous. Doesn't hit the number we want. In addition to the timing we want, we don't do it. It's like football. The quarterback goes back and counts 4 and throws to a spot to the receiver. We're the same way. We think that's where the cycle should be, but it's got to be at the right time. And if it's not the right time, we don't do it. So it's got to be level, timing, and direction, which are the 3 things everybody would like.
Gold and silver, so would you favor one over the other, or right now just take a look at the cycle?
Gold over silver.
Excellent. Where do you see the U.S. dollar going right now?
Dollar's up until Q1, which we've been saying for quite a while. Dollar's strong, and then it's going to really turn around. I mean, today it's very strong. And people are fleeing their currencies. Look at Russia, and that's just one example. But we believe that the DXY is something to look at. But we think Q1, Q2 dollar tops, and it's down long term.
The Dow and S&P 500, do they look like they're topping yet?
Yeah, that's in a topping process. We don't think it's got more than a few more percentage to go long term. We think next year. Now we still be long now. We're still in a buy signal for another week, but we think long term, next year is going to be a big swoon, down a lot and up a lot to get balanced, and then the next several years down, like considerably. And, not pleasant, but that's what it is. What we see anyway. And then at the end of the decade, it gets even worse. And then really going into the 20s, it begins a huge bull market. That's kind of the big 15-year, 16-year view. There will be 40% moves along the way. Obviously, that doesn't negate that, what I just said, but that's kind of what we see over the next several years, just enough to drive people crazy. And bonds is also going to be down. Bonds are going to be down, too. So you're going to have periods, stocks are down, bonds are down. So what are people going to do? That's always the question.
I've heard that bonds, the bubble on bonds might burst in about 6 months. Is that the projection?
We think we're kind of 3 to 6 months. Look, I don't know if I mentioned last time, rates were 18% 32 years ago, and they were 2% 61 years ago, which they are now. So that's a 60-year cycle. How many 80-year-olds do you talk to who remember rates when they were 2%? It's interesting. If you get a guy who's 80, who's sharp, who's somewhat financially oriented, you or your listeners should just ask him, do you remember in the 50s when rates were 2%? He'll say, yeah. Then it went up for 30 years, right, to the beginning of the 80s. It's been down for 30 years. So bonds have been a good trade for 30 years, and now they're bottoming. Again, it takes a little while, and then rates are going to go up again for the next 30 years, which means bond prices will go down. So how many people who have the last 30 years of lowering bond rates and therefore hiring bond prices, how many people are going to feel comfortable shorting bonds in something known as TBT, as an example? It's not easy. You're not used to it. So, but that's what we see as going to be a good trade longer term, not that long from now, just based on that analysis I just gave.
Crude oil is falling in price. Do you see it continue to fall?
Yes. We think there's a bounce here. We need to close above 68.50 for a small bounce, probably up to 73, but we think it's going to hit 58. Believe it or not, and then you want to go long like crazy. We think it also goes way back up. We got some pretty tumultuous moves coming, which just kind of shows what's fundamental. I love when people go, well, you're just technical. Well, excuse me. Does that imply we're lesser? This doesn't work? Or you think fundamental? Crude went to 147 5 years ago. If you go to our site, Charles on CNBC called it to go down a lot, and they laughed because it was at 147. Do you remember when it was that high?
Well, they told us it was going to go to 200 at the time.
Right. That was a goal. Anytime things go, that's what I always say. It's going to go even higher. No, he called it, and then 6 months later, it was 49. So is that fundamental? No. So that's our argument. The tracking of past patterns. Wow, that sounds poetic. Tracking of prior past patterns is the only way to predict the future. And so whatever we think, we need to be in gold because we're afraid of the system, you might be right, because it's what we think the system shows us. But that's not why we do things. We do things just because we try and track the repeating patterns from the past and not be influenced by the news. Like, can you predict what the news will be in 6 months or a year? No. The news comes out today, but in effect, that's what people are saying with their investments based on the news. Well, if the news says this, I'll go long, and if it says this, I'll go short. We think the news is built into the cycles, and then they give a reason why something's going down, but the cycles already say it's topping. We don't know what's going to cause the top. When we see there's a top, then something will come out causing it to be. We never know what it is.
So with a surplus of oil and natural gas from fracking, you couldn't have perhaps predicted that, but you knew just because of the cycle something would interfere and make it happen.
Let me give you a quick nat gas story. Again, I don't know if I mentioned it last time in the show. If I did, please forgive me, those who are listening. Nat gas was $12 not that long ago. Do you remember?
Exactly.
Went down to 6, started to move up, and then Charles said it's going to 2. And everyone said, can't be. Well, the Canadian banks made a lot of loans at $6 to Western Canadian nat gas producers. And then it went to 5. It went to 4.5, went to 4. And the banks, just like a bank making a loan on a house and it's underwater, they come in and call the loan. They were basically doing that to those companies, saying, you got to pay us because the loan covenant said your price has to be a certain way, otherwise you have to start selling to pay our loan back. So they started selling ahead of their production based on bank pressure. And the newspaper said bank-forced nat gas selling causes nat gas prices to go down. And we laughed. That wasn't the reason. It was cycle tops. Then all these things happened. And then the bank said, you got to do this, but it was the cycle top that led to it all going down. But there had to be some human event that others could pin the tail on the donkey and say that's the reason why. That was an example. We still think, we wrote today, nat gas is down longer term. Now you could say, well, with so much fracking, that means the supply will be so great. I don't know. It's just, I'm not so smart to figure out A implies B with all the news and all the stuff. And I think that's what Charles, who's quite a brilliant man, thinks also. I'm not so smart to figure that out, but I am smart enough to figure out the past patterns will probably repeat. How do I analyze those? That's kind of our system. Again, I recommend your listeners charlesnenner.com and write in for a free month of research where they get a Monday, Wednesday, Friday update covering stocks, bonds, commodities, and currencies. And then on Sunday we send a bunch of charts which show visually what we write about.
So, for example, you would know natural gas prices, they go in a cycle and it's seasonal.
Yeah, everything. Grains, corn, wheat, same thing, cycles. We can almost predict the weather, but people, will start saying something, but that's kind of what we think, because it's also cycles. It's just cycles. It's not one cycle.
Is the price of oil affecting currency prices?
No. Even though that is what people are going to think, the currency prices have cycles also. And so we just look at each set independently. We don't say because this, then that. But it's certainly, like, the argument is because we think crude's going to go up again after it goes down, then the commodity currencies related to crude, which are, of course, the Canadian and the Aussie, should go up. Which is what we think. But we don't say it's because crude's going up that those commodity currencies will go up at the time they do. It just, both cycles happen to go a certain way, so our brains think we understand A implies B, and we may say that, but in fact, that's something we think people should avoid thinking. Because based on thinking, who would think that the Dow would have continued up the last 6.5 years? Just based on, unless someone's really smart and says, I'm just going to hold long, it has to be. And then QE came in at a cycle bottom. And everyone could say, well, because of the QE, that's the reason why the stocks went up. Probably, but the timing of it was indicated by cycles. That's kind of how we contort the normal thinking, which we think is contorted to begin with. I guess that's the best way to say it.
Are central bankers then deluded to think that they're controlling the economy?
Yes. All politicians, by the way. They want to follow Keynes' philosophy because Keynes said you can actually affect things. So if you and I want to go into politics, we go around saying, everybody, vote us in, and we have the power to do this, right? And we don't agree with that at all. We think they don't. Charles said on CNBC several years ago, even Greenspan said there's an exuberance cycle. There's nothing we could do about that. I get even Greenspan. I mean, Greenspan was there at a time. A lot of people said he did great. A lot of people said he did poorly. Carter got elected at a cycle top. Reagan got elected at a cycle bottom. President Obama's been president for a 6-year stock run-up, right? Did he cause it? I don't think so. So it's hard to say cause and effect is what most people think. We acknowledge we're not so smart to think that, but we can say if 83 cycles or 21 cycles are all topping at the same time, that gives us more predictability than anything else our brains can come up with. That's pretty much how we work, and I don't know how many guests you have to talk like this. But
I have a couple who are on the same page as you are, saying they don't watch TV, they just take a look at Dow theory and the different cycles and where they are.
Okay.
And they say humans love to attach, okay, we saw a comet last night would be the old-fashioned example, and so that means we're going to have bad luck for the next 6 years. And
Right.
You would say it's a coincidence that comet showed up as the downturn in the cycle was about to happen.
Right. Well, I don't say it's coincidence. That's when it would show up. And I'll add one more piece to that. It's not even when it shows up. It's how it gets interpreted at the time it shows up. Give you an example. At a cycle bottom, IBM comes out with great earnings. People will perceive it to be, they did great, but they could do even better now. It's just a sign of something. At a cycle top, same earnings will come out, and people will perceive, well, they had good earnings, but this has been a long run. It's probably going to not be like this anymore. Same earnings. how it's perceived. So in effect, our system really doesn't look at events. It looks at the interpretation of events in the past and tries to find the pattern, how it was interpreted in the past, that's going to indicate how it's going to subconsciously be interpreted in the future.
Would you plead with the Fed right now? Please don't, when the down cycle starts, throw in quantitative easing again. That's just sucking more money out of the taxpayer's pocket for no reason.
Well, they wouldn't listen anyway. But that's correct, what you just said. That's why I think this whole thing's going to make it much worse. They could have, in theory, solved the problem. But then again, based on cycles, it had to be this way. So, we just think it's going to be a mess. The stocks and bonds overall down the next 7 years, bonds down the next almost 30, gold and silver up, although silver not yet, and gold just starting, and grains up, crude and nat gas heading down, but not too long from now we'll begin a pretty strong move up. Bunch of currency move. I mean, that's why I say write to our research. People should write in, get the research, be very patient. We wrote this. Charles wrote this for Goldman Sachs, what they'll see. So it's a pretty high level thing. It's like 3 sentences on each subject. The Canadian stock market, the NASDAQ, the Dow, the VIX, which is a big thing people should look at, the volatility index, gold, silver, crude, nat gas, bonds, 30-year, 10-year, TLT is a long bond fund, TBT is a short bond fund, and then 5 currencies every day, the Aussie, the Euro, the Canadian, and the Yen, and then we also do the Euro-Yen cross. Between that, you get a pretty good feel, and it takes 4 minutes to read. We're very big fans of dealing with people's ADD.
And that's all at charlesnenner.com, isn't it?
Correct.
David, thank you very much for chatting with us.
My pleasure, as always. You are a wonderful interviewer. You give the person time to speak, and it's a pleasure and a breath of fresh air.
My guest has been David Gerwitz, Managing Director of the Charles Nenner Research Center. After the break, Darrin Hopkins from Richardson GMP, next on This Week in Money.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Darrin Hopkins, Director, Co-Head of the Public Venture Capital Division of Richardson GMP. Welcome to This Week in Money, Darrin.
Hi, Jim. Thanks very much for asking me.
Today we're going to be taking a look at the troubles facing the Canadian equity markets. We know that small issuers on the TSX are in a lot of trouble. Is this just a normal cyclic downturn, or is there more at work here?
Well, my personal view is that it's not just a normal, routine market cycle. And I think if you stand back and look at it, I think you get a better understanding of why that potentially is what's happening. And if you look at the TSX Venture Index, it's at approximately, give or take, 700. This index was as high as 2,600 back a number of years ago. And if you look around the world, you'll see that most other indexes around the world have all regained where they at least were or are higher than where they were. So if you then say, well, this index is still at 30% of where it once was, then I think that that's an indication that there's a structural issue at play here, not just a normal market cycle, because it should have cycled out of this bottom that it's found itself in.
What's holding the market back?
Well, I think there are a number of factors out there that have all kind of confluenced on the public venture capital markets. And so if you, again, look at the dollars, 2011, there was approximately $11 billion raised in the TSX Venture. Last year, about $3.5 billion. This year probably comes in around $4 billion. So there's been $7 billion a year in public venture capital missing. And what happens is that $7 billion, there's a multiplier effect on it. It gets recirculated. So if you take $7 billion out, then the $7 billion itself is not there, but then all the multipliers aren't there. So you don't have funds trickling down into smaller public venture capital stocks. And that's traditionally where people take their money to invest. They generally don't invest in venture type exchanges with their earned income. They use capital that they've made in other deals. So right off the top, that's the first problem, is that there's just no new capital coming in to the venture exchange. Then you look at some of the other underlying factors that are at play here. First of all, you have a concentration of bank-owned brokerage firms in Canada. So in the last probably 5 years to 8 years, the assets under administration of the bank-owned firms has basically doubled. And the number of independent brokerage firms has continued to spiral down. So when I got in the business 20 plus years ago, there was probably at least 30 independent brokerage firms that all participated in trading and financing what is now TSX Venture companies, what was then is the Alberta Stock Exchange and the Vancouver Stock Exchange. When you're down to 2 or 3 independents, those are the guys that participate in that market. So you have a much narrowed field of people that are willing to participate. The bank-owned firms, for the most part, they don't want their brokers buying stocks in the TSX Venture Exchange. They just want them doing structured product, mutual funds, that kind of thing. So when you've eliminated that amount of wealth out of the venture exchange, that's a problem. So then you add in aging demographics. You have an older investing population in Canada who, again, is more adverse to risk and more interested in stability like a GIC or an income fund or something along those lines. You add in adversity to risk, and people's risk tolerances have changed significantly since 2008, 2009 period, where suddenly, in a generation almost, people didn't know they could lose money on the market or that there could be problems in the financial system. So you add that into the mix, and people want to avoid risk. Then you go down the list, and what we've seen over the years is what I'll call regulatory creep, and that's not a noun, that's an adjective, in that the burden of securities regulation has continued to increase on public companies. For a company like TransCanada Pipe or something like that, it's not that big of a deal. If it's an extra $1 million a year, it's not that significant. But when you're talking about a junior public company, where now all of a sudden they're possibly looking at 20% of their capital having to be employed to cover the cost of complying with securities regulations, well, that's 20% that doesn't go into the ground, doesn't go into their technology, doesn't go into testing, doesn't go into anything except for just paying to be a public company. So that puts them at a distinct disadvantage to private companies, but also at a distinct disadvantage to be able to make money. So then next issues on here is that you have, I think there's been too much of a focus over the last 10 years on looking for listings as opposed to looking for capital. And so while the exchange has done a great job of attracting listings from all these different foreign jurisdictions, the problem is they all come here because they need capital. We have a small market in Canada in terms of capital. So you've diluted the capital into possibly too many companies, and you haven't brought in more capital from other jurisdictions to feed the appetite of the companies that we have here. And when you're in a commodity resource type environment like we are in Canada, these companies need a perpetual string of capital coming in the front door. So that has added the problem. In my mind, we have an inefficient tax regime in Canada for public venture capital. It doesn't make sense to me that somebody gets the same capital gains tax break if they buy Bank of Nova Scotia stock as if they buy XYZ Junior Exploration or Junior Technology or Junior Biotech Company. The risk is significantly greater on a small junior company, so the reward for somebody investing should be greater, and so should the tax be different because you're taking a much greater risk. So I think we seriously need to look at the capital gains taxation in Canada.
Darrin, I was just wondering about that because I know it only accounts for something like 1.1% of government revenue, yet we know the regulations concerning capital gains tax are really keeping people away from putting their money in.
Absolutely. And it's, I don't even think there is much of a tax revenue loss for the government because people aren't putting money into the public venture capital markets right now. So there's nothing to forego. And if you're looking at ways to stimulate the economy, create jobs, create wealth for Canadians, then by offering them a capital gains exemption on, and I guess pick a number, maybe it's market capitalization of $500 million or less, then do that. And then the capital will flow there, and you will start to see these young companies being able to flourish and succeed. And investors make money, they take that and they plow it back into the market.
Isn't this what happened in Britain? They took the capital gains tax, and now Britain has the healthiest growth of new companies?
Well, different jurisdictions around the world have, in my mind, better capital gains exemptions available to smaller companies. And if you look at, and these numbers might not be exactly correct, but it's of the magnitude of the public or the venture capital deployed per capita in Alberta, for example, is about $30. I think Quebec's the highest in Canada at about $60 per person, venture capital invested. California, it's $320 per person. So you can see that the Canadians just aren't willing to invest into venture capital or public venture capital. So I think you need to stimulate somehow, and just having the government hand out cash to venture capitalists or creating fund of funds, that's not the answer. You want individual investors to be able to make that decision, knowing that if they do get a victory on one of these small cap stocks, that at least the taxes, they're shielded from the tax on it for a period of time.
Is the government paying attention to this issue?
No, I don't think so. I think that they're almost completely oblivious to the situation in the public venture capital markets right now. And, I've made this clear to several of the federal ministers in our government in meetings I've had with them, is that 8 or 9 months ago, a year ago, whatever it was, when I believe it was Heinz closed a tomato canning factory in Leamington, Ontario, and 40 people were put out of work, and it made front page news of the two national business papers. And yet here we have a public venture capital market that is missing $7 billion a year in investment since 2011, and there's not a peep, nothing. We don't see anything in the national business papers about it. You don't see any of our federal government officials, whether they're from finance or industry or what have you. They are totally ignorant of what's going on here, and it's quite frightening, actually, that this is a significant industry in Canada, and they have paid absolutely zero attention to it.
Is it because exploring for minerals or for oil just isn't sexy?
Well, it goes beyond that, because we're talking about biotech companies, we're talking about industrial companies, technology companies, real estate companies. We're talking about there's lots of different companies that are in the public venture capital markets, not just oil and gas and mining. And so if you are looking at stimulating an economy, take Ontario, for example. They have massive debt problems in Ontario, massive deficit problems in Ontario. They have employment problems. They have balance of trade. They have all these different issues. You need to stimulate that economy somehow. And certainly if you made capital gains taxes much less or non-existent for earlier stage companies, then you for sure would attract capital, and that capital would attract talent, and so you'd see action in those economies.
I know they want to give tax cuts to families, which is always nice, but I don't think that's going to be generating jobs. This is a system that if you cut or eliminate capital gains tax, which won't cost the government a lot in revenue, will create new jobs, new ventures, and of course that will generate a lot more tax.
Absolutely. The multiplier effect is huge, because all these companies, when they raise money, they go buy trucks, or they drill wells, or they buy machinery, they hire people to work. It just goes on and on and on. So the multiplier effect is significant, because when these companies raise the money, they spend it. They're not like a bank that gets low interest money from the government and then sits on it. They raise capital and they expend it immediately and put it into the economy.
Well, we've seen a cut in taxes work before. The federal income tax on companies has been cut, and it's attracting companies like Burger King to move their head offices here. Why not adapt that attitude when it comes to the venture exchange?
Well, I'm a big proponent of it. I've lobbied, I've sent letters, I've done all these things to try and get some attention drawn to this problem and try and get some assist with answers on this. And I put forward quite a few suggestions and propositions to them, saying here are things that don't cost. I'm not asking anybody at the government to write a check. I'm asking them to make it so that capital can flow more efficiently in this country, And that in itself will create what they're looking for, diversification, small, medium enterprises getting funded and starting up and proliferating through the country.
And of course, we know that small business is the biggest employer in the country. Why not give them a tax break like this so that more people are employed? It seems pretty simple to me. Don't the politicians get it?
No, I think they simply don't. I just don't think they realize the magnitude of this industry, and I don't think that they see the damage that's been done. I think they look at Bay Street and they see that the TSX index is up and they think everything is fantastic. And they don't look past that. And that's a very significant problem.
Of course, if there isn't any money to be shifted around, the Toronto banking industry will be in bad shape.
A significant number of the graduates onto the Toronto Stock Exchange come from the TSX venture. And so it's pretty short-sighted for them not to see what happens if that pipeline dries up. It will make a difference down the road to the TSX, the senior board, most certainly. But you've got to start looking at it now, because looking at it when it's an actual problem, well, it's too late then.
We'll have more with Darrin Hopkins from Richardson GMP next on This Week in Money.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're talking to Darrin Hopkins, Director and Co-Head of the Public Venture Capital Division of Richardson GMP. Darrin, why can't the government see that a reduction or elimination of capital gains tax and not fooling around with the markets that do work is the right thing to do?
Well, I think that, this falls in line also with Ottawa's idea on a national securities regulator, in that Ottawa is completely oblivious to the problem at hand right now. And so, and I'm tying into this national securities regulator because this misguided belief that they have is that for some reason that the rest of the world is not investing in Canada because we don't have a national securities regulator. And I've taken probably 120 companies public over the last 20 years from just about every corner of the earth, and at no time has anybody ever asked me, do you have a national securities regulator? It's absolutely ridiculous that they believe that this is a game changer. In fact, it's the opposite. A national securities regulator, in my mind, will spell the end of the public venture markets in Canada, because it will be another massive layer of bureaucracy headquartered out of Ontario, and this will be a regulatory group that is completely out of touch with what is needed in the various different jurisdictions. And in Alberta and BC and Quebec even, there's been a dynamic efficiency in the public venture capital markets that's evolved to meet the needs of entrepreneurs and investors. And so you look at the Junior Capital Pool program, which is now the Capital Pool Company program, was invented here in Calgary about 27 years ago. It took the Ontario government and their Securities Commission about 17 years to adopt it. We've had an offering memorandum exemption here in Alberta and also in BC for about 15 years. They're still reviewing it in Ontario. So if you eliminate the dynamic efficiency that's developed out here over the last 100 years in this market, then that is the end of the public venture capital markets. It will be over. And you will not see any of these junior companies listed because they will simply wither and die because they won't have access to capital. So there's, the first fix in my mind is well, don't buy into this national securities regulator, because that's not a fix, that's a problem. And more importantly, they have no measurement tools, this national securities regulator. I don't even know what it is they seek to do. The system's not broken, but they're trying to fix it. We have a passport system in securities regulation in Canada that only Ontario has chosen not to join. And now we're expected to believe that, well, it's all going to be one big cohesive family. Well, Ontario has always chosen not to join this passport system. And that's where you start first. And the federal government, instead of looking at what I say, instead of neutering the public venture capital markets in Canada, they should be focused on how to get more capital into this market. So it's, I proposed several, or at least one new exemption to the Alberta and BC Securities Commissions, which they are, they're reviewing with great eagerness, that is aimed at opening up the Canadian public venture capital markets to more Canadians by changing the exemptions we have in this country, which is a first step to liberating capital, make it available. I've suggested that we need to seriously look at a North American venture exchange as opposed to just a TSX venture exchange, because we have so much capital in the United States that it's almost impossible for it to work its way into the Canadian public venture capital markets. So I've pushed for quite some time now is to focus on the U.S., start meeting with the SEC and the U.S. government, and work towards building a North American venture capital exchange so these Canadian companies can get financed. I've continually said, quit chasing listings from abroad and chase the capital that's abroad, and by showcasing the great companies that we have here on the world stage, and take them to other markets and show them around. So that's one of the other ideas I've given them. When the income trust model was eliminated in Canada by the late Jim Flaherty, that really killed the junior oil and gas market. At that point, I think we had 500 publicly listed junior oil and gas firms. We probably have less than 40 now of that size. It eliminated the cycle of capital where a junior starts out, gets themselves up to 1,000 barrels a day, sells to an income trust, they take that capital and they redeploy it again and just keep that cycle going over and over and over again. And that cycle was broken when they eliminated the income trust. So that's a problem. I've also pushed very hard to get the TSX Venture and the TSX to become advocates of their clients, which are listed issuers. So when things like this happen, when the income trust debacle happens, the TSX Venture and the TSXV should have been lobbying Ottawa to say, whoa, hang on a second. That's going to affect our clients significantly. And by the way, these clients are the ones that are funding the future of Canada.
I'd say they're average Canadians, aren't they?
Exactly, yeah.
They want to invest in their country, and the government isn't giving them the avenue to do it. So what can we do to get their attention, to change things so that this country is back and strong in what it does best, and that's develop natural resources?
Well, I think, so many of these things have to come from the top down, and all I can tell people is that it doesn't matter what riding or what jurisdiction you're in, they need to speak to their local MLA or their local MP, or write them, go on their websites and say to them, like, look, we've got a serious problem in Canada that affects the economies of Alberta and British Columbia significantly. Why aren't you paying attention to our public venture capital markets? Why aren't you changing the tax code in this country that allows capital gains for these companies? Why are you looking at a national securities regulator that is going to squash the public venture capital markets in Canada? Why are you doing all these negative things instead of trying to help out and allow these entrepreneurs to flourish? We've had one of the most successful junior public venture capital markets in the world for many, many, many years. And other countries try to replicate it, and it hasn't worked for them. We've got it right here, and yet our federal government to a certain extent some provincial governments are killing this market with overtaxation, overregulation, and again with this national securities regulator. It's just you've got a system that's working, and they want to take a broken model because Alberta and Manitoba and Quebec won't join, and then overlay that over top of a model that works with the exception of Ontario not joining the passport system, and try to run it. It is absolutely lunacy for them to try and do this. So I would encourage people, this national securities regulator is out for comment right now until December 8th, but they'll take comments, for 3 or 4 or 5 days after that. If you look at the British Columbia Securities Commission website, if you look at the Alberta Securities Commission website or the Ontario Securities Commission website, there's right on there, it'll lead you to a link, and you can comment about this national securities regulator. And I would encourage everybody to comment and say it is a bad idea. It will be the national energy policy of the securities industry. And we know what that did to the oil patch here back in the 80s when they put that in. It killed it just about. And that same thing's going to happen with national securities regulators. So I just encourage people to get on the phone, send them an email and say, pay attention to this. We've got to fix this. And now is the time. One thing is for certain is that the federal government and even some of the regulators, they have a different sense of urgency than the people in this industry. And it's long past due for them to get on this and realize the urgency that's in the market right now and do some things to fix it.
Darrin, is there a website people can go to find out more about this?
If you go to the British Columbia Securities Commission website, I think it's bcsc.com, or if you just Google that, or if you Google the Ontario Securities Commission, or if you Google the National Securities Regulator, it's the capital markets initiative that the federal government's got out. If you put any of those names in, you'll get it, and they have a specific webpage set up for people to go right there and provide comments to the federal government on this national regulator. And within that, they can also say that there are problems in our public venture capital markets. This was not going to solve it. What would solve it is taking a look at it with regards to capital gains taxes, the overarching securities regulation, scaling that back, those kind of things. So people can make comments right there on that website, because it's set up to receive comments on this right now. And it definitely will send a message, because this is Joe Oliver, the Finance Minister of Canada, that's followed. He didn't come up with the idea. The late Jim Flaherty did, but Joe Oliver is blindly pursuing it. So it's important to send a message directly to him that, look, voters in all parts of this country think that this is a bad idea, and by the way, you should instead try to help fix this, not hurt it.
Darrin, thank you very much for being on This Week in Money.
No problem. Thank you.
My guest has been Darrin Hopkins, Director, Co-Head of the Public Venture Capital Division of Richardson GMP. That wraps up our show for this week. We'd like to thank our guests, Ross Clark, David Gerwitz, and Darrin Hopkins, and thank you for listening. I'm Jim Goddard. We're back next week with more This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.